I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. This week, there is an old adage that when it comes to war, you sell the buildup into war, but you buy the invasion. Right?
That's a crazy saying.
Or they say you buy when the guns fire, you know what I mean? But that's true. So we were advising our clients that you sell the buildup, but you buy the invasions.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
Good day, crypto investors. Today, we're dissecting the latest analysis from renowned financial strategist Tom Lee, who offers a compelling expert take on Bitcoin's future. Lee begins by reaffirming his long-held conviction, grounding Bitcoin's value in its powerful network effects, the very principle he used in 2017 to forecast its rise from under $1,000 to $25,000. However, he argues we are now entering a new paradigm. While market sentiment often follows predictable, albeit counterintuitive, patterns, like his buy the invasion analogy for market bottoms during crises, Bitcoin is evolving beyond simple network value. Lee posits that its utility is set to grow exponentially over the next decade. This growth isn't just speculative, it's being driven by fundamental changes in how Bitcoin is used and perceived, transforming it from a niche digital asset into a cornerstone of a new financial infrastructure that will unlock its path to six-figure valuations and beyond.
As the market was falling after Tariff Liberation Day, it was falling in a waterfall decline. And so we wrote very early that there have been 12 similar waterfall declines.
What's a waterfall decline?
It's a stock market that falls more than 10% within, I think we did it as a 2-week period. It's really rare to basically literally cause a plane to drop, 10,000 feet. And almost every waterfall decline is a V-shaped bounce unless there's a recession. So that's why we got so keyed up on this high yield market, because if we fall but we don't have a recession, that just means everyone just panicked. They did a fire-ready aim. And so we argued you would have a V-shaped recovery. And a V-shaped recovery is a symmetric bounce back to the old highs. And, of course, everyone argued against it for logical reasons. They said, tariffs, they're not going to be solved for a year, The Fed's not your friend. The Fed is going to – there's no liquidity coming like in 2020, so you can't have a bounce. There can't be any fiscal stimulus.
2025, no liquidity.
Well, no, in 2020, the Fed did
that's when they said it. Okay.
Fed did a lot of QE.
Right.
And they're like, there's no QE coming. But we said that history says you have a V-shaped bounce, especially if there's no recession.
Okay.
So that's what made this so hard for people to accept, because the Fed was hawkish and we still had a V-shaped bounce. I think that's the real lesson. The Fed liquidity is a myth. You don't need Fed liquidity for stocks to recover. I'd say that's really my takeaway from the bounce. And then for this week, there is an old adage that when it comes to war, you sell the buildup into war, but you buy the invasion. Right?
That's a crazy saying.
Or they say you buy when the guns fire, you know what I mean? But that's true. So we were advising our clients that you sell the buildup, but you buy the invasions. I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. When we first wrote about Bitcoin in 2017, and Bitcoin was under 1,000, we had said it could get to 25,000 by 2022 because it's a network value asset. So we just said if you model number of wallets and activity per wallet, which explained 90% of the move of Bitcoin from 2009 to 2017, you would get to 25,000 2022, and you can get to the six figures later. And that's true. It's still like 87% explained by those two variables. But Bitcoin is now about to become a lot more useful for two reasons. One is it's becoming less regulatory burdened, right? The White House is really creating it as a strategic reserve asset. And companies are putting it on their balance sheet because it's the way people used to have real estate owned in retail, like that wasn't a thing, but then people realized it was valuable to own the real estate. Like some retailers are more valuable because they own the building. That's what Bitcoin is, your working capital is. And then, but banks are also quite interested in Bitcoin because of stablecoins. So stablecoins might be the Web3 app that's really recreating financial services because one, a stablecoin works better than a regular dollar.
You don't have to send it through middlemen to transfer
Yeah,
it.
that's right. Now, if you want to move billions and trillions, you just use the stablecoin market. And it's proving to be more profitable for a bank. Circle, like I won't comment its valuation, but as a net income, or Tether is a better example because it's
But
not
how do
public.
you trust those Tether people? Like you don't really know what's going on.
Well, that's
behind the
where,
scenes.
see, this is where blockchain comes in. Blockchain has proven you don't need to know the counterparty. You just have to trust the code. And so Tether, from a net income basis, makes more money than most financial institutions. I think would be the third most profitable financial institution in the world.
Wow.
So what's a better bank, right? What's a better financial services model is building it on the blockchain. So I think stablecoins is the killer app that's proving, because Bitcoin anchors everything. Because you don't need a stablecoin unless you had Bitcoin. So Bitcoin and building financial services on top of stablecoins, and financial services companies are getting it now. Even Walmart and Amazon want a stablecoin because it's actually quite profitable to have one. That you are changing the financial system through crypto.
So Bitcoin's not at the top.
Yeah. So if you again model this out and utility, because remember stablecoins is only a $250 billion market today. So you realize that stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance.
Wow.
So the U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance. Its dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the U.S. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the U.S.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
The primary catalyst for this exponential utility, according to Lee, is the rise of stablecoins as the killer application for Web3. He illustrates the profound inefficiency of the traditional financial system, where even internal bank transfers must move through a complex external supply chain of intermediaries. Stablecoins obliterate this system. Built on the blockchain, they enable direct, instantaneous, and highly profitable value transfer, trusting code rather than counterparties. Lee points to Tether's staggering profitability, which rivals the world's largest financial institutions, as proof of this superior model. Crucially, Bitcoin serves as the foundational, decentralized security layer that anchors this entire ecosystem. As major corporations and even governments recognize the power of stablecoins to enhance efficiency and reinforce dollar dominance globally, the demand for the secure blockchain that Bitcoin provides will skyrocket, making it the indispensable strategic reserve asset of the digital age.
Let's say do approximate percentages.
Okay.
So let's just say that there's two ways to value markets. One is the underlying earnings, and the second is the expectations of either how good the existing numbers are or how much they can grow. So in other words, that's all the narrative part is essentially valuation. And to me, the adage in the stock market historically has been it takes a whole lot of E to offset PE.
Meaning?
Meaning that earnings can move 5% or 10% versus what you thought. But the reason the stock might go up 50% is more because of narrative. So I think that in like a very simplistic sense, narrative drives stocks more than earnings do over the intermediate term. we can see it in stocks that essentially have turned shareholders into customers, like stocks like Tesla or Palantir defy people's fundamental understanding of earnings because the valuation of the stock relative to its earnings seems far greater than someone can explain, but that's because these have really compelling narratives.
Right. And so with earnings, we're talking about profits.
Yeah, and Alex, I might be forking here, but
Fork away.
I believe Tesla and Palantir and stocks like HIMS are proof that money is not how you measure the value of a stock. Because if money is determined as the earnings per share, the value of a company isn't just the amount of money that it represents. It really represents a customer's trust in the actual business model.
Okay.
And so that's where PEs can actually be much higher, even for a level set of earnings. Like, let's say that a lot of your viewers are bearish, and they're bearish and they've been trying to expect the stock market to go down, or maybe they sold stocks in April. And then they're like, well, the only reason markets are going up is AI, and I think they're already overvalued. They're missing that there's a lot more to sort of the narrative of the S&P that explains why stocks are doing well. So that's why AI is important, but it's not the only story in the stock market. By the way, most people may not realize this, but money has to move through a supply chain.
Talk more about that.
Well, let's say that you're a bank in Asia and then you want to move money to the United States. You have to move it through an intermediary, and then from there it gets moved to another intermediary. So there's a supply chain. In fact, if you're a global bank, so take Barclays or JP Morgan, and you have money in, let's say, Japan, and you want to move it to the US, you have to use an external intermediary to move the money. Banks can't internally transfer the money because it violates OFAC or FinCEN. If a bank has money in Chicago, a branch in Chicago, and they want to move it to Texas, they have to move it externally through the supply chain back into the bank. Otherwise, so like you'd think, oh, they just do an internal transfer because it's all accounting and money is like imaginary in a sense anyways. It's just digital, but they can't. They actually have to move it externally first.
In his concluding analysis, Lee draws a powerful parallel between Bitcoin and narrative-driven stocks like Tesla. He argues that in the intermediate term, an asset's story and the trust it inspires can be a far more potent driver of value than traditional earnings metrics. Just as his contrarian call for a V-shaped market recovery defied bearish logic by focusing on underlying fundamentals over hawkish Fed narratives, Bitcoin's true potential is missed by those who cannot see beyond old financial models. The narrative is no longer just about digital gold. It's about Bitcoin becoming the trusted, immutable bedrock for a more efficient global financial system powered by stablecoins. This evolving story, combined with its proven network effects and newfound utility, creates a powerful argument that Bitcoin's valuation is not at a peak, but merely at the beginning of its next major chapter of adoption and appreciation.